So I'm chatting with someone who's 19 years old right now. How many stocks do you have in your portfolio?
I have 13 stocks and then 3 ETFs.
Right now, I have no stocks in my portfolio.
I own 5 stocks.
5, that's it. Do you own any ETFs?
Yes, 5 ETFs.
You own 5 stocks and 5 ETFs?
Yes, exactly.
Okay, do you own ETFs instead?
I do. I own 6 ETFs.
All right, 6 ETFs, 34 years old. Thank you so much.
How many stocks do I own in my portfolio? Oh, goodness. Well, I own a lot of index funds, so I guess technically, some of them own every stock in the market.
How many index funds do you own, or ETFs do you own in your portfolio?
About 20.
What's up, guys? Humphrey here. So how many stocks should you own in your portfolio? It's an age-old question in personal finance. So as we can see, it's kind of all over the place, but in today's video, I want to unpack this topic a little bit further and explain how you should be thinking about how many stocks you should have in your portfolio. We're going to go through some examples of what famous investors like Warren Buffett think when it comes to this question, as well as explain in depth what diversification is, because it's going to be a guiding principle on how we should be thinking about our portfolios. So starting with Warren Buffett, I found this clip online of him describing what he would say from a Berkshire Hathaway annual meeting.
Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses.
So what does he mean by this? Warren Buffett is basically saying here that you should own as many stocks as you need to feel diversified. The less involved with investing you are, the more diversified you probably want to be. And listen to what he says next.
There is less risk in owning 3 easy to identify wonderful businesses than there is in owning 50 well-known big businesses.
So it's not only the number of companies you own that matters, but the quality of the ones that you own as well. Warren Buffett subscribes to his own method, so if we actually take a look at all the holdings that Warren Buffett owns and we make a pie chart out of them, his top 5 holdings represent 77.5% of his total portfolio. So Warren Buffett, while he does own around 45 holdings, his top 5 represent close to 80%, and I would call this not very diversified at all. Again, he's a legendary investor and knows exactly what he's doing, and he does this for a living, so he's basically using his intimate knowledge of companies and financials to have concentrated positions on the ones he's most bullish on. And that's definitely evident because he has 45 different holdings in his portfolio. The top 10 account for 88% of his holdings. That means the remaining 35 only account for 12% total. But that's what Warren Buffett does. But how many stocks should the average investor like you or I own? That question is going to depend on a few things, but most importantly, it's going to come down to diversification and also your own personal risk tolerance when it comes to investing. The number of stocks that you should have in your portfolio should be equal to the maximum loss that you're willing to take. So let me give you guys an example. So if I only had 3 stocks, that means each stock is only making up 33.33% of my portfolio. If one of those stocks was to completely go under, well, basically I'd have a total loss of minus 33%. So if my comfort level was losing 33% and I'd be totally okay with that, perhaps I'd only invest in 3 stocks. Now, if I was comfortable with a position taking up 10% of my portfolio, maybe the answer is then 10 individual stocks, 10% each. If you're investing with ETFs, that's even better because now your risk is spread out amongst all the holdings of those ETFs as well. If you want to just invest in individual stocks and only hold those, that's where diversification is going to play a much larger role. So let's actually talk about it, shall we? The first way to diversify is through industries and sectors. So in the stock market, there are 11 main market sectors that have been identified, and those are sectors that are like things like the energy sector, the healthcare sector, the financial sector, or the real estate sector, etc. Now within these sectors, there's a total of 24 industry groups, 69 industries, nice, and 158 sub-industries. And that's actually quite a lot. So for example, tobacco is a sub-industry within an industry of the sector of consumer staples. So there are 11 sectors, and while you don't have to be diversified in each of these sub-industries, it's important to have exposure to all 11 of these sectors, ideally, either through sector-specific ETFs or specific stocks for maximum diversification. Taking a look at this table from the Seeking Alpha's homepage, every sector's year-to-date gain is going to be quite different. So on one hand, the energy sector is up around 20 to 25% this year, while technology is down down between 5 to 8% year to date. If we look at the 3-year returns, tech returned 130 to 140% in the last 3 years, while energy returned only 12%. This is a small example that just shows how important it is to stay diversified, because a sector may outperform during a certain time period due to certain conditions in the macroeconomy, but as we've learned from the past few years, the world is pretty unpredictable and anything could happen. Being diversified across all industries is going to be a must, especially if we're constructing a stock portfolio, and that'll actually play into how many stocks that we want to own. Let's talk about the second factor now for good diversification, and that's going to be market capitalization. For those that are new to investing, market cap is simply the total market value of a company's outstanding shares of stock. For example, if Apple had 1 million shares circulating in the world trading for $10 each, the company would have a market cap of $10 million, or 1 million shares times $10. It's really as simple as that. Now, obviously, Apple has a much larger market value, but it can be derived in the same way, which is you take the number of shares that any company has outstanding and multiply it by the share price. Now, generally, there are 4 different levels of market cap. You have small, you have mid, large, and mega cap. I'll bring up a table on the screen right now, but basically small caps are typically companies with less than $2 billion in market cap. Mid caps are between 2 and 10 billion. Large caps are between 10 and 200 billion, and mega caps are anything over $200 billion in market capitalization. Now, you might be wondering, why does market cap matter? So, from a very broad point of view, market cap is related to a company's progress in developing its business. Typically, investments in large cap stocks are considered more conservative compared to investments in the smaller companies, such as the small cap or the mid caps. The way I see it is that small cap companies have higher potential for crazy gains, while large caps are more stable and grow steadily instead. Think of them like ships on the water. A large cap is like a cruise liner, while a small or micro cap is like a nimble speedboat. If you put both ships on the open seas, the cruise liner is going to have a much more stable ride, but the speedboat might have a bumpier ride but get to its destination quite faster. That's my crappy analogy for the day. I hope that kind of made sense. Basically, large companies are much more stable than the smaller ones. Market caps are good proxies to figure out how much risk you're taking on, especially if you're juggling between risk and growth potential when it comes to investing. The third factor to good diversification is exposure to different countries. Going international with some of your investments is another diversification method that could help boost your returns through exposure in faster growing economies than just the US. Now, you might be wondering to yourself, hey, Humphrey, the US stock market has done super well the past 10 years. Why would I want to put my money into any other country's economies? And you would be absolutely right. The American stock market has seen incredible bull runs over the past 10 years, but the point of all this is that investing can be unpredictable. Who knows what will happen in the next 10 years? That's why it's good to hedge our bets with some international market exposure. A typical misconception is that increasing your exposure to international or emerging stocks would make your portfolio riskier. It's actually quite the opposite. So BlackRock actually found that by investing in global equities, you're actually taking less estimated risk overall. You can invest internationally through ETFs like the Emerging Markets ETF or the Developing Markets ETFs, both from Vanguard. Beyond the United States, developed markets include countries like the UK, Japan, France, Canada, and Australia. Looking at Vanguard's Developed Markets ETF, ticker symbol VEA, we can see that the ETF has the heaviest allocation in Japan and the United Kingdom. In its top 10 holdings, we have familiar companies such as Nestle, Samsung, Toyota, Louis Vuitton, and AstraZeneca. Developed markets are typically less risky and less volatile compared to emerging markets, so if I'm going to add some international exposure to my portfolio, I'm probably going with developed markets. You can also pick international individual stocks if you'd like, but as with picking stocks in any type of market, it can be quite risky and require a lot of research. So how many stocks do I have in my portfolio? So personally, I have 21 stocks and 3 ETFs, as well as an experimental 10 stock portfolio just for 2022. If you'd like to see everything I invest in, that's going to be in my Patreon, which will also be linked down below, and I hope you check that out. But many experts believe that there should be around 20 to 30 stocks in a healthy, diversified portfolio. Now, does that mean you need to have 20 or 30 stocks in your portfolio? Absolutely not. Personally, I think the right number of stocks in a portfolio is the number that you can handle comfortably. It's hard enough to keep up with the news on just a few companies, much less 20 to 30 different ones. Most analysts on Wall Street cover one stock and one stock only, and that's their full-time job. So I guess my final answer is that when it comes to having different stocks and holdings in your portfolio, have as many individual stocks that you feel comfortable with, and then add ETFs to kind of balance everything out. I'll leave another link to a video right here on how to build a rock solid portfolio, and I made this just a couple of months ago that should still be really relevant to you. So I hope you guys learned something today, and I hope that all this information was helpful in building a portfolio. I will see you guys in the next video. Peace.